Hello and welcome to this Business Today Market Special. I'm Udayan Mukherjee. With me is Aabha Bakaya, and our guest today on the show is a veteran of not just Indian but global markets, Arvind Sanger of Geosphere. Arvind, great to have you on the show. And we haven't seen this kind of volatility in markets since the start of the pandemic. What is it telling you? I mean, is it likely to continue for much longer, or is the market slowly approaching oversold territory?
I think the volatility is going to stay elevated because what we got, I'm not saying that the market is not, oversold and due for a bounce, but in terms of what has been the guiding star of the markets for the last couple of decades has been that whenever things got rocky, whether it was the pandemic, whether it was a 2008 financial crisis, or in prior incidents, the central bankers, led by the Federal Reserve in the US and, of course, other central bankers, stepped to the rescue. This time, there is no expectation that the central bankers are going to ease off their aggressive rate increases because inflation, which is at, I think about close to 40 years highs globally, is become a bigger problem than whether or not the equity markets are selling off. So I think that changes the fundamental underpinnings of the market.
Would it be fair to say, Arvind, that this is not just a routine correction in a bull market? I mean, it started like that we are in an overall structure or construct of a bull market, but it was a 10% plus kind of a correction which bull markets often have. Only in the last few weeks have people started murmuring the bear market word, that this may not just be a routine correction, it could actually even be heralding the start of a bear market. Where do you stand on that debate?
Absolutely. I think structurally inflation is on an uptrend. And because structurally inflation is on an uptrend, therefore structurally interest rates are headed much higher. Markets had a huge rally after the opening of the floodgates of liquidity after the pandemic broke in 2020. So 2 years ago, you had huge amount of liquidity and markets moved a lot. So, I think this 20% is, I realize it's well-used definition and it's very important. But what we have to keep in mind is where the market was 2 years ago, where it is now. You're just taking out some of the air out of that, significant, I guess what in hindsight would be a bubble, driven by extremely low interest rates. So, if you look at valuations in the US, valuations in India, valuations in many markets are not anywhere close to oversold territories compared to historical normals. They're only oversold compared to the high that we hit a few months ago. So that's the problem, that we use the reference of the high point rather than look at historical, mean multiples and say, are we at a level where we can say markets are really cheap? And that is not true.
I mean, you make an interesting point, Arvind. I mean, there's one way to look at the market is to say it's corrected 10-15% from the top. The other is to say what you're suggesting, that, a market which is still trading at maybe in India, say 18-19 P multiple, where the mean is probably closer to 15, which means this market can still fall 15-20% and only have reverted to mean, not even have got terribly oversold, trading at 12 P multiple or something like that. Do you therefore see that kind of downside potential in absolute terms, that it can take in another 15% even from here on the way down?
It certainly is a risk, because remember, what we're looking at is, China, which is going through, frankly, a recession, even if their GDP data will not reflect it, but every other measure would tell you that they're in a negative growth environment. Europe is teeter-tottering on the edge of recession, if not already there. US, there's a risk there might be a recession. When was the last time that you had a global recession and the Indian market was trading above its mean? The answer is never. So the reality is that if that scenario plays out, where the West does go into a recession, then there is no way that the market doesn't have another 10-15% downside. Now, am I certain that the US and Europe are definitely going to a recession? No. But is there a significant risk of that? Yes. Therefore, I think the markets are going to remain under pressure until we get clarity on where global economic growth is going.
Arvind, how are you adopting your strategy to the current volatility that we're witnessing globally? And specifically when it comes to India, how do you feel foreign investors are perhaps changing their stance? And do you see this further accelerating in the weeks and months to come?
So, on a global portfolio, we are very overweight anything related to energy. The world is short energy. India is having power shortages. Coal is in short supply. Europe is having power shortages. Natural gas and coal are in short supply. US natural gas prices are at 14-year highs. So the world is extremely short energy. It is extremely short other resources. Base metals would be doing much better if it were not for the China lockdown. None of these problems have a magic wand solution, and energy transition and ESG only makes the problem worse. So we think that's a theme that's going to be around for a while. It's not going to economic slowdown is not going to solve the energy problem. That's a global perspective. India is energy deficient. There aren't many companies that you can play in the energy space. And as we've seen from the news over the last couple of days, India has put tariffs on steel and iron ore exports and increased or decreased excise taxes on petrol and diesel, and at least on petrol. I'm not sure if it was diesel too. But the reality is that what that means is global inflation is going to keep growing up. So our view is we're staying in hard assets, real asset plays, but staying in cash in the short term a little bit, because these kind of policy moves like what we saw this weekend create huge amount of uncertainty as to where you can hide, so to speak, in this market. Right. The steel stocks were down double digits today. So we would look for buying some of these whether it's real estate, whether it's domestic infrastructure providers, whether it is whether it's a base metals, whether it's energy. Those are the kind of places we would look at, and we'd be very cautious about inflation losers. You've seen WPI inflation is at multi-year highs in India, if not close to multi-decade highs.
It's interesting that you mentioned commodities, Arvind, because we started the year talking about a super cycle in commodities, and metal stocks were doing so well. And then metal stocks have just been hammered out of shape in the last couple of weeks. There are concerns on recession, on what China is doing. And that seems to have taken all that steam out of the low supply and commodity prices rising in a super cycle, that whole argument out completely. Do you see this as an opportunity, or do you think the commodity or metal bull run has ended?
It's just beginning. This is just a pause along the way. Nothing ever goes straight up. But the fact that in energy transition, you need, 3 to 5 times as much copper in electrification, of cars. You need 5 to 7 times as much copper in solar or wind versus thermal power plants. So right now, because China is, 35-40% of the world's copper demand, and China is going through a severe lockdown. Now, I don't think for the rest of our life you're going to have a Chinese, zero COVID lockdown. So once this ends, which I suspect will be by year end, if not sooner, we're going to see the underlying tightness in the market for commodities like copper, aluminum, steel. All of these are essential in energy transition. And China's short-term headwind is not structural. The demand for these is structural, and the supply growth is relatively very, very slow to come on. And therefore, I think that global market is there. On energy, or coal prices are all-time highs. Natural gas prices globally, except in the US, are at all-time highs, and the US is multi-decade highs. And oil, again, the only thing holding it back is really China's zero COVID and people not moving around. So I think the commodity bull market is far, far, far from over. What we do have is a pause because of China, and we think this is going to be a great opportunity to buy when people come to the conclusion that this is over. And it seems like in India, stocks are getting a little bit overdone on the downside.
The other segment which has got hit quite badly because of all the global turbulence and fears of a US recession is IT, because a few months ago everybody was talking about how IT should do well because A, it's defensive in nature, B, the demand metrics are very strong. But now the opposite is happening. Most of these Infosys and TCS are getting hammered down. I mean, for something which has been the core staple of global investors like you, how are you approaching this severe correction in IT names?
I think it's setting up for an interesting entry point. Again, there are two headwinds. One of what you talked about, which is the recession fear, and the other is margin compression. The IT companies benefited from a couple of short-term factors which came about because of the pandemic. One was obviously much more offshoring, and the second was much lower travel costs. So both of those are slightly reversing, and there is therefore some margin correction happening. But I think, digitization and the general move towards more outsourcing, which has become much more acceptable because of COVID and the remote work, is a tailwind that will be with us for a long time. The recession risk is clearly a demand. So the demand side, there's a little bit of a recession risk. On the cost margin side, there's a margin pressure. We think the margin pressure will be temporarily just adjusting back to a new normal. We think the recession risk starts to get discounted, and the outsourcing mega trend and the digitalization mega trend is more powerful than whatever moderate impact that a recession would have, which would be therefore, I think, a good entry point in the next few months or weeks if we see much more of a pullback in these stocks.
Arvind, the analysts say that consensus seems to be that the dollar is going to continue to get stronger and stronger this year, naturally, because some of the factors at play. But what are the implications you feel, on the currency front? We're closely eyeing this sitting here in India.
Well, I think, inflation is a global phenomenon, and some central bankers are being more aggressive than others in attacking inflation. Fed is clearly at the forefront. ECB just came out with a statement a few hours ago saying they expect to remove negative interest rates by September. I mean, that's, in my opinion, that's clearly part of the reason, because they're so slow in reacting. That's part of the reason why you're seeing the US dollar almost at parity with the euro. And I think a similar challenge is present in India, where RBI has been extremely accommodative. And I have argued for months that it's behind the curve. And I think the big risk, they've used up a lot of dollars to try to defend the rupee. But the big risk here is, if inflation is going to keep rising, if current account deficit is going to keep expanding, as oil prices go up, then therefore the risk of Indian rupee. Look at what happened. If you're reducing exports by the steel and iron ore tariffs that the government just announced, and you're lowering your excise duty on petroleum products, you're encouraging more imports because that means the demand will stay strong, and you're discouraging exports. What does that do? That increase your current account deficit, increase your trade deficit. All of these things will put pressure on the rupee. So I think that there are many reasons why the rupee we are very cautious on. And one other sector I forgot to mention, pharmaceuticals. Some of these stocks are oversold, and that could be another beneficiary. So we're also looking at companies that are relatively immune or relatively benefiting from a weaker rupee, because we could certainly see that as a risk on the horizon.
The one trend we've seen, Arvind, over the last few weeks is that there has been a severe compression in valuations of digital stocks. I mean, the Nasdaq has got hammered way more than the S&P or the Dow, and some stocks there are down 50-70%. We've seen that bloodbath in our market as well, with some of the newly listed digital stocks correcting 50-70%. Do you think much of it is done, or as interest rates climb higher, this space in India and overseas will continue to correct or shed even more in terms of valuations?
Well, one of our best shorts has been Kathy Wood's ARK, the ETF, which reflects many of these quote-unquote digital stocks, new age stocks, and what she calls disruptive stocks. I think India flavor of some of these new companies is not that different. The only mistake we made is covered some of that too early. But I think we are probably overdue for a dead cat bounce. That's all we're going to get. I don't think we are. The fundamental environment again. One of the challenges or one of the mistakes investor make is to look at the rearview mirror and use the reference of what was hot yesterday to assume that if it's come down a lot, it'll get hot again. And I just think that those ridiculously high valuations for these earnings-free companies with earnings way in the future is something that's going to be much harder to come by. So I think we are entering, what I would call probably maybe a little bit extreme, but a nuclear winter for some of these profit-free stocks. And yes, there will be a few real winners if you can distinguish the winners. Just like in the early 2000s, if you had bought Google or if you had bought Amazon, you would have done well. But for every Google and Amazon, there were 20 others, Pets.com and others that went by the wayside. So the risk is, excuse me, the risk is not being able to figure out which ones are which. And therefore, I would say that it behooves investors to be very selective or be very patient.
Well, it's caused a lot of heartburn in India for people who've lost money in these digital names. But the one name in which the last couple of days have not been very good is LIC, because a lot more was expected, and that's one that just has not had a very good debut. So how do you read that? I mean, the way LIC has broken into the market and what it does to the ecosystem of insurance stocks in India?
It doesn't do that much, in my opinion, to the ecosystem of insurance stocks because, in almost every sector where that has existed, including in insurers, the private sector has, on a structural, secular basis, lost market share to the public sector. And the private sector, to the private sector. And the public sector has, delivered much poorer returns. Like look at the banking sector, much poorer returns and trades at much lower multiples. For decades, the private sector banks like HDFC did very well, while the public sector banks, including the lead of SBI, did relatively poorly. Recently, obviously, that's reversed, but that's taken a long time for SBI to get there. I think LIC is going to be, unfortunately, a similar story. I mean, LIC, it's funny that when in the past PS offering would be failing, it would be LIC getting the call to bail out those public offerings. I'm not sure if LIC can do it for its own shares. So therefore, the bailout is not there. Now, there's at some point, LIC will get interesting too, because it is a market leader. It has a great franchise of agents globally. I mean, all over India, nationally, and therefore it has some value. We're just not sure, we're ready to play what is going to be over time a structural loser in a sector where the private sector is doing quite well.
Arvind, we saw these major swings in the Indian market last week, from one of the worst, days ever to one of the best, continuing just simultaneously the next day. Any specific stock perhaps that's really stood out to you in the kind of moves it's made? I know you may not talk too stock specific, but I'm still wondering, in case you're even observing just as a story. And retail investors, Arvind, who are the primary new additions to the stock market, they continue to remain invested largely, and domestic investors are also pumping in money. There are concerns that they're going to be really badly burnt should the tide turn. As you said, while it's cautious investment at the moment, what happens if things really get worse?
Well, I mean, I think what was interesting was that the small cap stocks did very well, right? So the problem that I see is, and some of the retail equivalents in India of Robinhood did well, and so the retail investors are staying strong. These kind of stocks are doing well, but I think that's going to be a challenge going forward. Is whether or not the retail investors can hang in there and deliver the kind of returns that investors are hoping. I am somewhat skeptical that investors are rushing in too quickly, retail investors.
All right, Arvind, we'll leave it there. Thanks so much for joining us on the show today. Great chatting with you. And hope to continue to get your views right here on Business Today.
Thank you.
If you like the video, do like, comment, share and subscribe.